6 months ago, a 45-year-old mailed the last mortgage check, a $42,000 victory, decades in the making. Today, after a sudden job loss, their bank account is empty. The dream of being debt-free has become a trap. You cannot eat drywall, you cannot pay bills with bricks. Why does owning your house outright leave you so exposed? A final check, signed with a flourish, slides into an envelope. $42,000 gone in an instant, but the feeling is electric. Years of budgeting, skipped vacations and side gigs have all led to this moment. The mortgage ledger now reads 0. For the first time since their 20s, the homeowner stands in a house that is truly theirs. The relief is almost physical, no more monthly payments hanging over the kitchen table. Friends and family call to congratulate, and some even bring champagne. There is talk of new freedom, of money that can finally go to dreams instead of debt. The sense of victory is unmistakable. Every finance guru, from Dave Ramsey to Suze Orman, would call this the summit. Security at last. The walls feel sturdier, the future brighter. It is a ritual that promises safety, belonging, and peace. Yet beneath the celebration, a silent question lingers. What did this sacrifice actually buy? 6 months after the payoff celebration, a pink slip arrives without warning. The job that funded years of careful saving disappears overnight. The checking account, once a source of pride, now shows a balance barely covering next week's groceries. Every dollar of emergency cash was poured into the house, brick by brick, under the promise of safety. Now the mortgage is gone, but so is the income. Bills keep coming, utilities, insurance, property taxes, and the bank account empties. There is no paycheck to refill it. Friends who toasted the debt-free milestone offer sympathy, but sympathy cannot pay for car repairs or prescriptions. The house, fully owned, sits silent. No one wants to buy it in a hurry, and tapping its value means facing banks that demand proof of income. The sense of security evaporates, replaced by a cold realization. Home equity cannot be spent at the grocery store. The walls that once felt safe now close in, trapping wealth that cannot be reached. A paid-off house looks like security, but it's a paid-off vault with no key. The money is locked away, trapped behind drywall and bricks, impossible to reach without selling the roof over your head. Try paying the electric bill with a deed. See if the supermarket takes a shingle for a loaf of bread. You can't eat drywall. You can't pay a mechanic with bricks. In a crisis, all that equity becomes dead weight. It is impressive on a spreadsheet and useless in real life. The bank will not hand out a home equity line if you do not have a job. The house sits silent and immovable while the world demands cash. This is the cruel joke of dead equity. You sacrificed every spare dollar for a sense of safety, and now you're stuck. The home is yours, but your options are gone. Security isn't how much you own, it's how fast you can access what you need. Paying off a mortgage at 4% feels like a win, but the numbers tell a different story. That final payment locks in a return of just 4% per year. Guaranteed but unimpressive. Meanwhile, the S&P 500 has averaged between 8 and 10% annually for nearly a century, even after the worst crashes. On $100,000 of equity, that is a $4,000 gap every single year. Compounded over decades, the difference balloons into 6 figures. This is the math banks use to get rich. They borrow your savings at a low rate and lend it back at a higher one, pocketing the spread. Homeowners who rush to pay off their mortgage are, in effect, choosing the bank's side of the deal. They accept a lower yield, not because it is the best financial move, but because it feels safer. In reality, the so-called security comes at a steep price, a lifetime of lost opportunity and slow, silent erosion of potential wealth. Banks hold the keys to your home's equity, and they do not hand them out easily. To unlock a home equity line of credit, lenders demand more than a deed. They want steady paychecks, clean tax returns, and a debt-to-income ratio that fits their formulas. Lose your job and your pile of home equity suddenly means nothing to the underwriter. A paid-off house with no income is invisible on a loan application. Even with perfect credit, banks like Chase or Wells Fargo routinely deny home equity lines of credit to anyone who cannot prove regular earnings. The rules are strict. No W-2, no loan. In a crisis, this barrier turns a home into a fortress that keeps its owner locked inside. Meanwhile, a fully owned property becomes a bright target for creditors and lawsuits. Unlike mortgaged homes, which are shielded by the lender's claim, a house with no debt is exposed. One court judgment, or an unpaid tax bill, and the county can place a lien on the property, forcing a sale to collect. The dream of security, once so close, now hangs on the whim of an underwriter or the threat of a legal notice. A 30-year fixed-rate mortgage is more than a loan. It is a time machine for your money. Every payment you make stays the same, locked in for decades, while the world outside keeps changing. Inflation chips away at the value of each dollar. What feels like a burden in the first year becomes a bargain by the 20th year. In the late 1970s, double-digit inflation cut real mortgage costs in half within a decade. Today, even at a modest 2 to 3% inflation rate, a $2,000 payment in 2025 shrinks to the equivalent of about $1,200 by 2045. The longer you hold on to a fixed-rate mortgage, the less you're actually paying in real terms. Early payoff destroys this hidden advantage. Instead of handing the bank tomorrow's weaker dollars, you give up today's strong ones, and you rob yourself of inflation's silent subsidy. Over time, this edge widens the gap between those who keep their debt and those who rush to erase it. The system quietly rewards patience, not haste, turning the cost of borrowing into a shrinking target with every year that passes. Picture two neighbours, both with homes now worth $800,000. One sent every extra dollar to the bank, chasing the dream of being debt-free. 30 years later, they own a house and nothing else. The other kept the mortgage but invested $1,000 a month into the market. Compound growth does its work. That steady stream, earning 8% a year, swells into a portfolio topping $2 million. Both have a roof. Only one has a war chest. The gap is not a rounding error, it is a $1 million canyon carved by the simple choice of where each dollar goes. Security, or the illusion of it, comes at a staggering price. There is a smarter way to win the game. Build a freedom fund. Instead of sending extra cash to the bank, invest it in a portfolio designed to yield steady income, for example, 3 to 5% on $500,000. When dividends and interest cover your mortgage payments, you are mathematically debt-free with cash at your fingertips. The house is still yours, but now you have an engine, not just a trophy. A paid-off house sits silent on the shelf. A well-built portfolio fights for you, ready for any storm. The choice is not between safety and risk, but between being stuck and being free. There is one clear exception. When your mortgage rate climbs above 8 or 9%, paying it off becomes the smarter move. At that point, no stock market average can reliably keep up with the cost of your debt. But even then, discipline matters. Any cash freed up by a payoff is a magnet for lifestyle creep. Bigger cars, more gadgets, expenses that quietly swallow your new breathing room. The real win is using high-rate payoffs as a tool, not an excuse for unchecked spending. Set your own rules and make every dollar count. Today, over $30 trillion sits locked in US home equity, untouchable for millions facing sudden crises. As inflation erodes cash and markets reward liquidity, the real risk is being rich on paper but powerless in life. Security is not bricks, security is access. What would you choose? Drop your thoughts below.